Hey, Jeff Carlisa here from 38 Special, and we're rocking it up right here with Traders Nation.
Welcome back. You're tuned in to Traders Nation. My pleasure to have with us here today John Grace. He's founder and president of Investors Advantage Corp. John, welcome to Traders Nation. How are you today?
I'm good, Kurt. Thanks for having me.
Yeah, you're more than welcome. Appreciate it. So there's this representative, Kevin Brady. He's a top U.S. House tax writer. He's floating around this tax bill that relates directly to retirement plans and the IRS. Do we have any details about this tax bill?
Well, there aren't a lot of details. There's a lot of proposals. It's 297 pages. I'm not sure how it's going to ferret out, but I sure hope, that if there have been some noises that they could have the required minimum distributions pushed back, and as where they are right now, it's at 70.5. You have to take out 3.65% of your previous year's account balance, and then it rises every year for the rest of your life. So, a lot of people have resentment toward that because they don't really want the money or need the money, and they have to take the money and pay the tax on the money.
Right.
So surely, if people are working longer, and if they can be allowed to work longer and maybe retire at 70 as opposed to where most people retire at 63, that gives them a chance to accumulate more assets and not spend down and then outlive that money. So if there's anything that comes out, where they can delay or push back the start of those withdrawals, I think that would be a good thing.
Right. So what John's talking about here today, folks, is called required minimum distribution, or RMD for short. And the government, IRS, forces folks that have retired to take out a calculated amount out of their IRAs each and every single year, whether they need it or not. And what it does is it forces that distribution out of their IRA account. And it's a taxable event, and the IRS loves this, right, John? Because this is tax revenue to them. It's probably the most easiest money the IRS will ever make is from a forced RMD. John, your thoughts?
Oh, absolutely. And let's understand, some people say, oh, gosh darn it, those tax dollars at work, right? And they're mad as hell. But let's understand that these accounts have been kind of valuable from the standpoint that you haven't paid tax on any of this money. You made, in many cases, tax-deductible or tax-free contributions, tax-deferred growth. And at the end of the day, over a 30-year period, you may have 30% more money that's on your bottom line that now you can spend. But here's the other part of the equation that you just touched on, and this is looking around the corner. What do our cars say today? Objects on the road ahead. Oh, really? I will pay attention. So what the financial services industry and the accounting industry has not helped people see is the withdrawals at 7.5, as I say, is about 3.65%. That's pretty innocuous. Stick around to 95, and now the withdrawal is 11%. Okay? And so, that means they're trying to get you to spend this money before you leave this good earth so they can get all the tax money because they never had the tax money. It also begs the question of the distinction, Kurt, between what we've been told to do for the last, 50, 60 years, buy and hold, which makes sense when you're making contributions. However, that practice that was your friend may become your foe when you're taking withdrawals. If you have another 50, 57% loss on top of your 3 or 4% withdrawal, it's curtains.
It certainly is. So the amount that people are forced to take on RMDs accelerates every single year as somebody gets older. That amount increases every year because the IRS wants you to draw. They really want that tax money before drawn down. They want it drawn out and drawn down so they can get a hold of that tax money. And certainly, like you said, you may outlive your money because of the acceleration of the RMD's requirements every single year. And we don't want that. So what are the changes? Is there any? I know this bill's floating around. It's like brand new. A lot of people still don't have the details on it. Is there anything in there that may change to help those RMD requirements that we know of, or?
Well, one of the suggestions I've heard, or one of the ideas that I think is part of this legislation, is to make exempt $50,000 of aggregate retirement savings from those required minimum distributions and make them COLA adjusted, cost of living adjusted, as opposed to set in concrete.
Right. Okay. So also there's apparently in this bill, there's some language. It fixes some technical problems and errors that were made in the tax law that passed just last year. But part of it is also to force the IRS to provide better service, if you will, maybe revamp how they service the American taxpayers. Your thoughts on that, John?
Well, I mean, anything that makes the IRS look at things a little bit differently or maybe with fresh eyes,
sure,
we're all open to. You know, we need to have fresh eyes to the questions as opposed to, well, this is the template and you simply must follow it.
Sure, and I wonder if we'll ever I can't imagine for a minute if we'll ever be able to force, even with policy, the IRS to make changes in how they do business within their own organization. That would be interesting to see, let alone. All right, let's focus on small business employers. There's some language in this particular bill that helps employers pool and provide retirement plans for their workers. Any information on that do we have?
Well, we certainly need a lot more information about our retirement plans. I mean, we tend to look for the easy answers.
Yeah.
We tend to look for the ways that we can set it and forget it. And as you know, and I think as everybody is waking up and discovering, everything keeps changing in the next nanosecond. So there is nothing you can afford to just set and forget. There simply has to be more information. There should be more conversation. There should be more discussion. I mean, we'll talk about church. We'll talk about religion.
Yeah.
We'll talk about sex, but we don't talk about money, right? And what does it take for each of us to determine what we need so that we can retire with dignity on time and not outlive the money? More of those conversations, I think, is entirely healthy. I would love to encourage that and to see that kind of process expand.
Do you think that we may see, because I know in the small businesses they have only a limited number of plans that they can really look at. They've got the simple plan, which you can have, I think, up to 100 employees participate in that particular plan. You got the individual 401ks, which, by the way, I particularly like, but have some certain restrictions and criteria and stricter criteria that needs to be met with those individual 401k plans. And of course, you get into the big, larger pension plans. Small businesses don't really get into those big pension plans. So do you think we may see some loosening or maybe some criteria for some of these small business plans like the simple or individual 401k?
Well, one change we have seen, Kurt, and I think it was in the right direction relative to 401ks, is the default position for if you didn't choose to be, wherever you wanted the money to be, if you just could not figure out where to put the money. It used to go to cash, which is really a terrible place for money to be for 20, 30 years, okay? Now it's in like an age-based kind of a target weighting kind of arrangement, so that as you get older, the portfolio is supposed to get more conservative. Now, it's worthy to look to see how those programs worked in 08. I wasn't really enthralled with how they performed when a market was off 37%. So I'm not saying that's the panacea. I'm just saying that's an improvement to the extent that there are mandatory contributions that are required. I would vote for that. And then the third thing is to increase your contributions. Say you only start at 5% or wherever the company matches. But let's have a mandate that every year your contributions have to increase by 1%. That's not going to hurt you. Right. But let's see that, people, as I say, we look for the easy answers as opposed to discovering. If you're young, it might need to be 10% of your gross that you contribute. If you're older and you haven't saved a lot of money, it might need to be 20 or 30% of your gross that you need to set aside, to retire at 63 just to catch up to have enough money. But if you're going to do it the easy way and you don't take the time to really figure out what your plan is, like you do on every vacation you take, then you're going to wake up and it's going to be shock and awe, and that won't be pleasant.
And we don't want that, do we? 1% is not bad. I think there's a cap at 10%. If I'm not corrected, John. All right, so John, we're out of time. Where can we find you? Do you have a website, anything like that we can find you, John?
Yes, sir. Easy one. WhyBePoor, spelled out WhyBePoor.com.
All right. We certainly do appreciate your time here today, folks. Listen, everybody, head on over to John's website and check it out today. Give John a call. Do all those great, fantastic things. Get engaged. John, thanks for your time today. Appreciate it.
Thank you, Kurt. Take it easy.
You bet. Stay tuned. We'll be right back.